Welcome back and congratulations for making it to part 2. I hope you're all well on this Wednesday evening. Just let me know you're seeing and hearing me okay. That'd be fantastic. Awesome. That's great. Thanks, Stuart. Cheers, Chris. All good. Hi, Ewan. G'day, Michael. I hope you got your issue sorted. Hey, Colin. Hi, Andrew. Right. Okay. Well, we will be looking at live markets possibly, because I want to make this a little more practical. We want to see what's cooking now in terms of some of the things we're going to talk about. Obviously, it's part 2. So what's going to happen is I'm going to put the recording for this in the same place as part 1. So you got the email saying this is where the recording is for part 1. So it'll give you a chance to replay it at your own leisure. And I hope you've all been busy beavering away on those trading plans based on the example template that I gave you. Now, what we're going to do today, of course, is follow on from what we covered in the last session, where we just sort of explored the nature of trading plans and why it's important in your overall trading systems. We looked at the key errors people make and sort of tried to look at making things specific and unambiguous, meaning that you could get consistency in your trading actions, and of course subsequently be able to measure that through your journaling process. How quick was that I mentioned the journal? Stephen, just drop me a line about the handouts. I can't put them in that. Actually, maybe the handout is still there. Is that handout still there? Yes. So if you weren't here in the last session, that PDF of the example trading plan is still up there, so you can feel free to download that as we're talking. We sort of looked at some of the key components of a trading plan, and obviously we give you that example to guide development of your own plan. So moving on from that, of course, or just to actually reiterate a couple of the key points about how trading results occur. Of course, we start with market action, we interpret that. We need to apply these developed systems, and of course this is mostly about development, and then of course you've got to have the application not only to develop them but also follow through on them and take that interpretation of market action with your systems and make some decisions, and ultimately of course results occur. So we talked about that again, and then we talked about what should be in this plan. So your outline, and your trading purpose, your code of conduct, which I hope you've started to work on, and of course your strategy outlines. Now, we are going to talk some strategy outlines today in a little more detail as promised, just to give you a little more meat around some of these bones, and also talk a little bit, and this is going to be very, very quick, okay? So what I'm suggesting that you do is I'm aiming to give you an overview, albeit a rather detailed overview of how you might look at that, look at these particular strategies. But there'll be enough there for you to start to develop a plan on each. But what I would say is, if you haven't done this to date, then do one first, follow the process around that, and then once you've done that, it sort of gets easy to develop the others, because there's two things that are important to recognize here. First of all, in many cases, the exit strategy you're going to use, irrespective of most of the strategies you're going to use, is going to be the same. Okay, that's the first point. The second point is that if you develop a breakout system, for example, through a resistance, then really in essence you're using the same clues once you've identified what for example, what a double bottom is or a reverse head and shoulder. You're using the same clues, because essentially with those you're breaking through a neckline or a confirmation point, depending on which pattern you're using. So to get one done, and as I've said, I think the breakout strategy is a great one for many of you to start with. Then that's it makes it easy to subsequently go forward. Of course, once you've got a plan and planted your flag in that, that's not the end of the game. It's only the beginning, because what you've then got to do is develop a method of gathering evidence to see how well or otherwise it's working for you, and refine your plan according to your findings. And of course, the only way to do that is through measurement, let's take a step back, is through not only having that plan, but religiously trading it and measuring the, or recording what's happened in your trading journal. So we're going to go through some of that process. I'm going to give you a couple of how-tos as well, with some examples. So that's what we're going to do first. So if we look at the 4 primary key entry approaches, we're going to look at the first 3. Really, we've covered the longer term economic idea in an Inner Circle webinar on its own. So if you need that, then feel free to drop a line to me. Can you send me later the link from part 1 and part 2? Ron, can you email me? I'm going to put my email address in chat, but if you can do that, then that would be awesome. And then that means I can action it accordingly. So it's Mike.Smith. More than happy to do that and help you in any way I can. There we go, Mike.Smith@gomarkets.com. That's it sent. So it's in chat at the moment, so just use that for anything that you. Okay, you've emailed me this afternoon, Stephen. I'll have a look at that. Been busy preparing this afternoon. Okay, and as well as those 4 primary entry approaches, those 2 secondary approaches, again, we've covered these in Inner Circle sessions recently. So one on accumulation, one on trend continuation, which a lot of you have already, of course, attended. But I'm just going to give you a quick summary of some of the things that we've, or briefly, but where do you start? So in terms of putting together a new strategy, and there are others you can develop over time. So you may see, well, look, I really like this long-term trend change. I really like a price mover through a 200 MA, or I like a 50-200 MA cross, or I like a flapping duck pattern, or whatever other pattern you come across. Then it's exactly the same process. So what you do is you start by looking at the anatomy of the move you're trying to trade, okay? So describing what it is in terms of price. Then, of course, you look for those additional clues that are going to create those higher probability entries that we talked about on many occasions, and any other considerations specific to that strategy. And that would include things like the instruments you're going to trade it on, the timeframes you're going to trade. And of course, then what will your exit strategy look like? So this is your process about where you start with each strategy. And I've got a little 8-point checklist about developing a new strategy, which I'll show you in a little while. And if any of you want that as a handout, then again, just drop me a line. I'm happy to do that for you. So I'm going to start with exits, because it is all about exits at the end of the day. Anybody can click a button and there we go, we're in. And the other reason we are starting with exits is, just have a quick look and making sure. Okay, yeah, I think I've answered everything to date. You could use flapping duck as rhyming slang for maybe market conditions, which are a little surprising, I guess, Eric. Good, good call. Okay, so let's do. There's a guy called Nigel Hawkes who we occasionally invite on. He actually has a strategy which he terms a flapping duck, which is a candle pattern thing. So that's where it came from. Okay, so if we look at exits have the purpose of either managing capital risk or profit risk, and that means really we don't want to give it all back. So we've got our initial stop, which could be a technical landmark or a consistent technical criteria, such as we talked about 1.5 ATR below the entry signal when we met last time. We talked about trend continuation, except that was one. Then we talked also about profit targets, and if you put that at the next key level. So if you're going long, maybe 0.8, 0.5 ATR, but no, below the next resistance. The good thing about using something like the ATR rather than pips or cents or points, just to reinforce a key point, is that it adjusts for particular timeframes. And then with your trail stop, you can use a 20 EMA or a signal line on MACD or a couple of other things. And we'll talk very briefly about trail stops in a while. But in the latter case, it doesn't work with some strategies, particularly on a bounce. It best works when there's already been a moving average course, which essentially is usually your trend reversals or your breakout trades. So in that case, you can use something else. Now, we talked about this last week. So we talked about trend continuation. So I'm not going to invest a lot of time on this, but we're using a price close in the top third of the candle, possibly a 0.5 ATR through a pivot point, increasing volume from the last bar and greater than 1-to-1, and potentially an RSI over or below 70. So if we look at something, let's just have a quick look. Let's see what we can find. Okay, so here's one. So this is a good example. Let me just draw something, change the pen color to yellow. Okay, so we see here, a couple of ways you could trade this, but you can see here, we could have traded the breakout there, but rather we pick this up with trend continuation. This is actually a flag formation, and so we trend, there's the trend pause, there's the candle we're interested in, bottom third, high volume, so there's our ticks and away it goes, okay? So that's actually a really good example. I'm just going to flick through a couple of other charts just for future reference, just to see what's going on. There's some really good moves today, this evening actually, a little earlier on. You can see there's a nice breakout trade on the Euro USD, starting just to lose a little bit of momentum. But you can see there that ticks all our breakout boxes, which we'll come to in a minute. Okay, so that's our trend continuation. Oh, sorry, we should have shown where the RSI was to be complete. So that was the Kiwi yen. So bang an RSI on just to see if that was okay. Oscillators, RSI relative strength index. There we go, to a 14 period. So you can see at that stage, we're not in an oversold position yet. We're just over the 30 line there at around about 33. So that's fine. That would tick our box and we're good to trade it. So that's our trend continuation, which we covered last week. Right, let's just have a quick look. As I said, I'm just quickly looking around and see what's going on. As is often the case when you want something to happen, oh, that might be interesting. Okay. Right. Okay, so that's our trend continuation strategy, which we talked last week. Now, of course, from that we talked breakout. So again, if we look at our anatomy, we're looking for a congestion exit. We moved into congestion or a sideways trend. We're looking for a break either way. And really what we're wanting to see is a price close through the key level and candle top in the top third. Sorry, the price in the top third, bottom third if it's short. Potentially 0.5 ATR through the key level and increase in volume from the last bar. So it's not that complicated, but it still requires you to do the right thing. Obviously, with all of these entries, you're also keeping an eye on economic data, and within your plan, you can make reference to that with reference to timeframes you trade. So if we look at our breakout trade, we'll look at that Euro one, bang smacking trade on that candle there. There is the breakout. There is the big fat candle. There's the volume. There's the close of the top third. A really nice breakout trade. And on that 30-minute chart has already clocked up 20, 30 pips, 29 pips, 30, maybe 32 pips. Now, just going to pop a little MACD on this. I might explain this later. Nope, still good. Oh, God, I put a MACD on the volume. What a numpty. Okay, there's our MACD. Okay. Right. Okay, so there we go. All good. Nice example of a breakout. Let's just look at something else. Let's just look at a, now this is a couple of ways you could play this now. It's not a good breakout. Would have been a breakout to the downside, but you can see that that candle doesn't really fit. It would be that candle would have entered on, and we could have taken advantage of that. Let's look at precious metals. Have been rocking and rolling. Let's look at silver. Actually, gold's a far better. Okay, let's look at silver where it's at now then, okay? Because I did want to show some things that are, if you like, live now. So here's a breakout trade, potentially, okay? So you can see there's the resistance at 28.25. So this is the bar we're interested in. We might even put this on the hourly chart, okay? No, let's leave it on the daily. Let's leave it on the daily. So first thing is, the day isn't over, okay? The day is long way from being over. So should we trade this on a daily chart? Well, no, we shouldn't, okay? Not a mature candle. So we're not seeing full volume on this. We can't make a decision on where the price is going to be on the candle, nor where the volume is, okay? So we can't trade this on there. The other thing, of course, relating to this is the next key level is at 28.98. If we put our risk, let's say we did enter this, we'll probably put our stop around about 114 points, okay? So around about $1.11. We're half of that to our next key level. So we'd reject that because there's not at least 1-to-1 in that, okay? So we're not interested in that nonsense. We're going to leave it well alone. Okay. Whereas if we'd seen this, shoulder, head, shoulder, break through a neckline, increase volume on the daily chart, there was the mature candle. So it could have entered. Interestingly, it pulled back and retested that again. So you've got to be careful with this. So we'd probably have our stop at that level there. Okay, so it would have got pretty close. So usually put it at the bottom of the second shoulder. There we go, actually. Let's put it at the bottom of the second shoulder where the wick is. And then we're going to use the 20 EMA as a trail. So came back and retraced again. And now we're sort of doing okay on this daily chart. Okay, at that stage, with our stop there, 79 points, our stop here is about 190 points. And we probably would have set a profit target here and taken that off. Thank you very much for the memories, Mr. Silver. If we look at what are my thoughts on, I'll come back to that if I may, Stephen. If we look at Euro Aussie. Okay, so when we met last week, we sort of looked at this idea. So you can see, let's just get rid of these lines. Put this on a line chart. What can you see? Well, you can see it's got a trading range, quite a big trading range of around about, on the hourly chart, of around about 90 pips, okay? So as it approached this level here, there are two things that could have happened. Okay, we'll put it right up there. There are two things that could have happened at this level here, or at this level here. Firstly, it could have done exactly what it did. It could have bounced. Okay, second thing it could have done is broken through this support, but it didn't. So point one, you've got to be patient until it's complete. Okay, point two is that even if it had broken through there, would we have got enough out of that? Yeah, we probably would have. We might have got down to there. So that would have been okay. But we wouldn't have entered this at all. It didn't close below that line, so we would have left it well alone. So remember, you've got to wait until your plan is ticked on all boxes. So we'd want, essentially, at this stage, another candle. Oh, I'm going to test my drawing skills. It's always a worry. So we'd want a red candle here. Okay, all right. We want this to be red. We want it to be closing in the top third. So we'll color that in yellow. Pretend that yellow is red. So we'd want it down here before we actually entered it. Okay, so it wouldn't meet our criteria at all. So we'll just leave it alone. If you want to, you can set if you see this sort of thing happen, you can set a pending order on a demo platform for a break of wherever half an ATR is. In this case, it will be 18 cents. So we'd set 18 pips. So we'd set a level at 9 pips below this. So it'd be 155.94. And we could set a pending order on our platform, and that will give us a ping if we set it up with our notifications, and that would mean that you could go forward and then have a look at your live account, make sure it meets all your other criteria. Looking at where it is now, it's not interesting me. I'll come back and have a look when it starts to tackle 156.86. So about another 18, 19 pips above where it is now, and then we might start to get interested in it. Okay. Can't look at this chart. SVL, Stephen, it's not on MT5, so we can't do it. Okay, so let's look at another chart, see what's setting up right now. Let's look at Aussie New Zealand dollar, Aussie US dollar. Let's look at a 15-minute chart. Right, okay, so two things that could happen here. We're looking at this right now. We're looking at this and we're saying, well, look, what it's done is it broke through that level maybe 3 hours ago at this stage. But at this stage, all it's done is it's retraced back to that level. So there's two things that could happen here. It could bounce off here, or it could go down here. What might it do? Well, we don't know. It's a flip of the coin at the minute. The market's flipping a coin and say we don't know what to do with this. Let's wait and see what happens with the candle. If we get a red candle down here, we could be into it. If we get a green candle up here, it could be setting up for a bounce. The problem is, in both of these cases, it's a bit blooming noisy. There's not going to be much to be made on either side of that, even on a 15-minute chart. So we'll just forget this chart. We'll go look somewhere else. Okay, so let's look at I didn't want to do that. Just get rid of some objects, clean it up. Let's say we'd seen this on the hourly chart and we thought, oh, well, that looks interesting. So we could have entered on this. Does it meet our criteria? Well, it did there. It certainly got volume there. So quite conceivably, we could get into this on a breakout of this level here. Does it look... so what it's done is it's done what 30 to 40% of breakouts do. Let's come down and test this key level. So we could be into this. What would stop us getting into this? Well, probably very little, actually. So quite conceivably, we could be into this trade and we'll probably have a stop around about this level here. That will be just one of these trading ideas that didn't work out. Okay. Oh, wrong box. Okay, what I wanted to do is look at copper. Actually, not. That's not. I don't want to get hung up on one breakout strategy. Anyway, you get the idea. So, always looking at trend reversal. So, anatomy of a trend reversal, we could use a moving average cross, or we could use a confirmed chart pattern. If it's a chart pattern, well, it's exactly the same. I've referenced it already. A neckline on a reverse head and shoulders is a breakout. A confirmation point on a double top or a double bottom is a breakout. So it becomes easy from then, because once we've defined that, and of course the definition of what we're going to use as our EMA, so for example 10/20, then we can sort of add the other things we would normally do to increase our probability of it going in direction. So we want a price close on the bar. We want no key price level, perhaps within 2 ATR. or 2 times risk. We want or an increase in volume from the last bar. So if we look at trend reversals, let's see if we can find a moving average cross. So these are 10 and 20 we've got on here. Okay, so not a great example. Just have a quick scan around these. Okay, so look, there's an example on silver again. There's the moving average cross. There's the bar. We would see this cross. We would see this candle on this. We wouldn't get in here. We wouldn't get in here. We wouldn't get in here. We'd get in on this one. If we thought about getting into this one, well, look, we've got a resistance there. So if we thought about getting in down here, then the resistance is too close. So we'd wait until it broke that. And in fact, it broke that and then we came down and then went higher again. Okay, so often retraces. We often see that. If we look at ores and minerals, we've got to go a long way back to get a moving average cross on this. There we go. There's our moving average cross. There's our candle of interest. We trade this. We'd probably take profit around here. If we look at Euro USD on the daily chart, there's the cross. Would we get in on this candle here? Well, no, because there's too much noise here. So we'd actually wait until this candle here, making sure that we've got increased volume, which we do. Okay, and then we trade up from there. If we look at one the other way, we didn't get 10 and 20. Let's just reset this template. Okay, there's our moving average cross. Okay, we're not seeing a candle there that lights our candle that really fits our criteria. The other thing, of course, is we've got something that's really close in terms of that line there. So we'd look at that, we'd see the moving average cross and say, forget it, maybe we'll go somewhere else, or we'll maybe come back and have a look at this when it's broken over this level here, and we might sort of enter something like that. Let's look at a New Zealand Kiwi. We would have certainly been a good trade. See the moving average cross there. We've got a candle which is in the bottom third. We've got increased volume on that one there. That's a good trade on a moving average cross. The other thing with moving average crosses, we might want to say they're both pointing in the direction of the trade that we want to take. The other thing is we could put on a third moving average and make sure that, for example, we'll probably not use a 200, probably use a 40. We might want the 40 to be pointing in the same direction as the others, or certainly not going against it. That suggests that, see how that's flat, that's okay. If it was still pointing upwards, we'd not be interested in that trade. So we can see here, there's the cross. We'd wait until it had broken through that resistance on that cross, and we can also see that it's trading above the 40 EMA, so that's all good. We could take that trade quite happily. So 10, 20, if I'm trading moving average cross, it would be a 40 on there as well, just to make sure that's pointing in the same direction, or as a minimum flattened. I usually have a 200 MA, which I use just for daily charts, Stephen. Okay, now, so that's our trend reversal. So you can see how really there isn't a lot of difference. Have we got a bounce? Or maybe come to a bounce later. Accumulation, we talked about this at a previous inner circle. So we have a few rules about this as a subsystem. So if you're accumulating, we need a reason to accumulate, such as a breakthrough next key level, or continuation in trend after pause or retracement. So we still want top third, increased volume. Okay, and what we do is we accumulate with no more than our original position, and then trail everything up together. So if we had 3 positions, let's say we had entered a position there where the red line is, and let's say we entered another position here, and we entered another position or more position here, then what we'll do, if we used our 20 EMA as our stop, then with this one, we've made 14 pips. With this one, sorry, with this one, not actually a great example, we'd made 6 pips, 5.3 pips, and with this one, would have actually given back 5 pips. Okay, so that was an accumulation trade that didn't work out. However, if we accumulate into this one, then we're in a good place. Now, there's reasons why we wouldn't accumulate into this, because there's no candle there. Actually, we might accumulate at this point here. Possibly being caught on that third one. So I'm just trying to keep into a. So MA cross and increased volume is not enough. Need to take into consideration next resistance, Leanne. Good questions. It's just because we want to make sure that there's enough upside in this to keep us interested. So I'll try and find a good example. Right. Okay. Do you see this moving average cross here? So there's our moving average cross. Okay. What we have with this is, you see, our next resistance is actually there. So we've actually potentially got very limited upside. So if that's the case, then we would delay entry until it had broken that. And indeed, if we'd done that, still top third, still high volume, we possibly would have entered on this candle here. Maybe not on that one because it's not top third, but certainly on that one there. So the moving average, it's already crossed. We've got a breakout there. And then eventually, we probably would have got stopped out at nothing there. Okay, so that just would have been a trade that didn't work out on the 15-minute. Let's just have a quick look at the daily. That's so choppy. So choppy. This is why you shouldn't have been trading daily for a while, because of this nonsense. Just get rid of our. Just trying to find. Oops. Just trying to find some good examples. Let's just check out something else. Okay, let's just get rid of our drawings because it's getting very messy. There we go. Okay, so let's say we're interested in this here. Okay, so there's a moving average cross. Okay, there's no real resistance until this point here. Okay, to the downside on this. So put it back on here. So we could have entered on this candle here, but we look at this and we think, well, now we're at the end of this candle. There's very little difference between that and our next support. So we'll just leave that alone, look for a different opportunity. Okay, so we want at least 1-to-1. That's what we're aiming for, Leanne. And remember, we've talked before about one of the clues is you want some, people are more likely to get interested in a trade when they see a lot of potential than just a little potential. And so you want to be on that at the start of the queue. So where's the bounce strategy? Give me a second. Maybe I didn't try to do a bounce strategy. Okay, let me just find a slide, okay? It's not that long ago since I did a bounce. Give me a second, guys. Okay. All right. Okay, so here we go, anatomy of a bounce. So what are we bouncing off? Well, things like 200 MAs, support levels, resistance levels for short trades, fib retracement levels, fractals, whatever you're choosing to use as a bounce. You often see with a bounce, you'll often see those long wicks and small bodies. We'll have a look for a couple of examples. And we're wanting to look at the pre and post bounce candle action. So we're wanting to see the new trend, i.e. the bounce, engulfing the last candles of the previous. So if we look for examples of that, there's a couple of share CFDs are actually looking like that at the moment. Qantas could be one of them. So here's an example of a bounce. So we've got a bounce off, there's a key level, which is a previous resistance, now it's become support. So we've got a bounce off that. Wouldn't have traded that candle, would have waited until that one. Okay, did we get volume on that? Let's just put some tick volume on. Let's have a, bring it up close. So not a massive amount of volume on that. So we could have actually rejected that as a bounce. If that was higher, we'd certainly be keen. So we'd have a look at this tomorrow and see if we get another green candle. It engulfs that one as well, and we get some increased volume. We could be up for a ride higher, but it did close in the top third, obviously, though it opened there too. Let's just put some tick volume on this. Okay, so let's take this. Okay, so now there's two things we could do with this. So when it pulled back here, we could have said, well, look, okay, it's pulled back and it's pulled back to a level which looks as though it could be important. Okay, so there's an important level. So I played with it there. You can see how many times it tested this before it broke higher. Okay, so what it's done is it's retraced back to there. Now, look at this. So there's two ways we could play this. We could say, well, look, we can trade a trend continuation, in which case we're going to wait until it breaks that, or we're going to trade a bounce. But if we're going to trade a bounce, we want to see a big fat candle. We want to see it closing in the top third. So that's a good example of a bounce, although it really, really did bounce. So you can see that was entered once it had broken the top of that earlier in the session. But that's a good example of a bounce. Let's just have a look at maybe that's just a breakout trade there. We're not interested in that. Okay. So here's a potential bounce strategy. So it's a downtrend. We see it playing around with this. We've found a level of support at that stage. Oops. And then you can see that this, just put this, oh, come on, Mike. So if we see where the previous highs were, there were the previous highs, so it almost went into a sideways trading range, and then we've got to close above that. Now, that would be a very aggressive entry. Otherwise, we've got here. So we'd have to be really on the ball to trade that because it only just is above, wouldn't fit our half an ATR. So we'd be in on this candle, high volume. There's our bounce complete, even though we could wait until this candle here, and that would be a retracement followed by a move higher. We could have entered on this trade here and would be away at this stage. Could have even profit taken on that. What would that be out of interest? That'd be 43 pips or so. Now, here's the problem with the bounce strategy. Let's bring it up again. Let's see what to trade here. Okay, what do we notice? Well, we notice two things about this. Let's see where to enter on the previous candle. Be very aggressive entry. Okay. First of all, it is high volume. It is in the top third. But first thing we notice is it's actually below the 20 EMA. Okay, so that means we can't use the 20 EMA as a trail. But also, in terms of where the MACD is, you can see at this stage, the MACD is still showing that it's only just, the signal line has only just moved below the histogram line. Most of the time we use this for the MACD, like in this case here, we'd be in perhaps at this candle here and would be out at this point here. Okay, when the signal line had gone over the histogram. So there's a clear sort of indication there that, or clear lack of consistency and exit strategy across, compared to that of your breakout trade or your trend reversal, or your trend continuation, where the MACD is invariably in positive territory if you're going long, or negative territory if you're going short. This is in negative territory and you're going long. So you've got a decision to make. Do you just scrap this, forget it, or do you say, well, that's okay, we're just going to use an alternative? Okay, once we're on this candle, we're good. We're good to go. The MACD has moved virtually back to zero, although not quite, but we have got it above the 20 EMA. So what you could say in your rule relating to bounce strategies is, I'm not going to trade this unless it's above the 20 EMA if going long, or below the 20 EMA if I'm going short. Then at least you've got something consistent you can use as a trail. Alternatively, of course, if you're happy using retracement points, then you can do that too. Just thought I'd quickly show you that, and that's a bounce strategy. So, okay, so here's let's find another one. I'm not going to get much bounce on that. We've just got trend pauses on here. So again, a good example. So we look at a trend pause here. We'd pop our line in the sand at that point there. Okay, we could say that's our pivot high, and then we get in there. And we'd set a stop down here. That's what we talked about last week. Okay, so then, so let's assume you've developed 1 or 2 or even 3 strategies that you've started to test out and trade. You've got your exit systems in place. You've got all of these. You've got your entry subsystem, your capital risk subsystem with your initial stop and your position sizing, and your profit risk, which will be your profit target and your trail stop. Let's assume you've got all that in place. Let's assume you're following these, and then we've got our measuring systems or our journal, where we're recording what we've got, what we did, what our results were, okay, with our consistent trading religiously, our trading plan sort of approach. Then our next task is to refine that plan so it fits us, our trading style, our interaction with the market, when and how we do it, and of course, what timeframes and vehicles we choose to trade. So we've got a series of what are termed intervention systems, where we can look at elements of our subsystems and make alterations. But we can only do that, of course, if we trade something religiously and if we record what we're doing. Then we could feed back the results from that into our trading system. So evidence-based trading is, as I've termed it, is all about creating a weight of evidence to say this is the right plan for me. What are the advantages of that? Well, obviously, if you've got something that fits you better, it's gonna behave better in the market. Also, of course, the more evidence you gather that something is working for you, and what works for you and what doesn't work for you, the more confident you become in your system. The more confident you are, as we've talked about on psychology sessions before, confidence is the cornerstone to good trading. It's a cornerstone to disciplined trading. It's a cornerstone to you developing further as a trader. So as a basis for your move into evidence-based trading, you need your recording system, your journal. You need those specific statements that we talked about last week that are followed religiously and are measurable, i.e., did I or did I not, okay? And a method to review these. Now, what I've done, because I'm a nice guy, is next week's intermediate trading clinic is on measuring trading performance. So we're going to cover these in a lot more detail then. But what I've done is I've added a date to this session which means that you'll all automatically be registered for that. So you'll get a notification when I change it all around. I think it's the third Tuesday in June. So you're all already registered for that. So you don't have to do anything, just wait for the notification that's coming along. We're going to cover this and the whys and wherefores of journaling, looking at your key numbers, looking at evidence in a lot more detail then. So what we're doing in this process of evidence gathering and basing our trading on evidence is refining our system to fit us as individual traders. So some of these things include new system development, refining parameters, adding or removing indicators, the reliability of strategies and alternate market conditions. You could find that at some stages your breakout trade works best, and at other stages your bounce strategy is the outperformer, and that may be dependent on what the underlying market strategies are. And of course, once you get to and that's really sort of going to a more intermediate to advanced level. And then of course also at an advanced level is once you get a method of assessment, of a sort of objective method of identifying market risk as an overview, then you can start to look to position size according to that. I'm just checking through Google. Cool. All good. Okay, so those are your how-tos. Now, I'm not going to go through all of these because, as I said, we're going to look a lot of these when we do the measuring trading performance in next month's Intermediate Trader Clinic. Okay, but I thought I'd give you just a couple of things to have a wee look at, just to sort of illustrate what I'm talking about here. So our how-to about how to develop a strategy. And if you drop me an email and want this as a handout, put in the message strategy considerations or something like that helps me know what handout you actually want. So I'm happy to put this as a one-page PDF and share it with you. So the first question you ask is, what does it add to my trading that is not already in place or could be better? Okay, so that could be that I haven't actually got a strategy to trade a bounce. So that's what it's adding to your trading. What primary price action is the entry strategy based upon? What supplemental evidence do I need to increase the likelihood of high probability entry? So there are your clues, and I've just given you an example of a couple of easy ones to get started with. How you're going to manage capital and profit exit risk regarding your stops and your position sizing. It may be that you're choosing to use this on some market vehicles or timeframes, but not on others, in which case you'd put those in your development process. Are there any market circumstances that may increase or decrease the risk in this trading idea? Well, difficult to come up with an answer to that, but quite often you'll sort of see one market doing better than, so you might see the FX market doing slightly better than share CFDs or vice versa, or indices outperforming or easier to trade, or the whole thing just looking choppy on a daily chart but quite directional on an hourly chart. So that's really just within your strategy saying, well, look, can it cope with these conditions? And if you don't think it can, then perhaps you don't trade it. So if we're trading it in if we're in a choppy market, then that means that there's not a lot of volatility. It's often trading within a range. Then trading bounce strategies is very hard. If there's been a strong direction, if it's a strongly directional market and there's a change in direction, that could be an opportunity to trade a bounce. So we may describe within our trading plan what market conditions may suit this strategy. And of course, we're looking to make those statements sufficiently clear and unambiguous to facilitate consistency in action and measurement. And finally, is there any additional information I need to record beyond that which I already use? So an example of this would be if you're already let's say you've only been trading one strategy and you've moved to trading 2 or 3 different strategies, then obviously within your journal, if we're going to compare the success of one strategy versus another, then you need to actually document in your journal which strategy it is that you're using. So if you follow those 8 development considerations, that essentially is your how-to list about developing a new strategy. Let's look at another one. Let's look at a refinement of one of those subsystems. So obviously, in the initial stage, you might use something like a 20 EMA as your stop, just to get things started. But obviously, there are a number of different ways we can do this. We can use the price cross and the moving average, i.e. the 20 EMA. So we've firstly got to identify which moving average we're going to use. Are we going to use an exponential? We're going to use a simple. Generally speaking, people use a simple. And which period? Are we going to use trend pause or retracements? So what contributes a pause? And if we are trading a long trade, how close to the pivot low do we put it? And I'll show you examples of all of these in a minute for clarity. And then we use the MACD signal line versus the histogram. And are you going to use the default settings or settings of your own? And is it an any time or a bar close? Okay, so let me just explain what we're talking about here. So let's put on, I don't think there's going to be much difference, but let's do this. Okay, let's do this on gold. Okay, so we've got a breakout here. Okay, see it's in the top third. Put some volume on this. Let's just make sure. Nope, dropping volume, not interested. Let's look at something else. Sorry, was that a bit brutal? Okay, I want to find a trend that's or a trade that's already gone. Okay. Okay. It's not a great run, but we'll try it anyway. Okay. So there we've got our breakout. We'll just make this green. So you can tell what we're talking about. Breakout, increased volume, tick, 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 top third. Okay. Now we might get a bit twitchy about this because of the close proximity of this, but let's just ignore that for the minute. So if we just use the 20 EMA, we'd be in here and then we'd alter the stop on every hour to wherever this 20 EMA is, and then we'll be out at this point here for 25 pips profit. Okay, so that's trail method 1. Trail method 2 is, let's say we use it, this is our initial stop. When it retraced like this, what we'd do is we'd move it up to this point here. When it did this and then went higher, we'd sort of move it up to this point here. And so we'd probably be out at this point here. Okay, so again, around about that 25 pip mark. If we use the MACD signal line, you can see that where the histogram crosses over the MACD is at this point here. You can see how it's above the MACD there. So it'll be out on this candle here. Okay. So we would make 37 pips out of that. So we've essentially added 50% by using that method. Let's look at another one. Let's look at a trend that's already done. Let's look at the DAX. We haven't looked at an index yet, but let's look at the DAX as an example. Okay, so there's our breakout trade. Boom. Okay, so if we use our 20 EMA on this, we're trailing. Now we might get caught on this one. Sorry, let's just put our MACD on this as well. Yes, we would. We'd get caught on this one. Okay, so we would be in here and we'd virtually make, what's that? That's 129 points. Okay, if we used the SMACD, we'd be out on, you can see there's where the signal line crossed. So it'll be out on that one there, and we'd make 220 points. If we use retracements, so this would be our stop, let's say here. Okay, we'd move it up to there after that retracement, and then we'd possibly be triggered. If we're not, which we might not be, once it started to slow down here, we'd move it up to there and be triggered there. So in that case, the retracement method would be better. That's rare. But if we trade one and we trade it religiously, then we can look at the other two methods of trading stops. And we can say, well, look, let's compare them now. I'm going to go into this in a bit more detail. So then we could start to decide, well, what's, in terms of my trading, my interaction with the market, what's the best set of parameters I should use, or the best, if you like, subsystem I should use for trailing a stop. That's the point I wanted to get in and just show you what I meant by showing you. Drop me a line, Stephen, I'll sort that out for you. Although if you've got the recording link from the last one, it'll be the same recording link for this one. Okay, so it might look like, to start with, you might plant your flag in. I'll turn my stop using the 20 EMA at the end of each candle of the time frame of trading. And then you might say, well, if the distance between the current price and the 20 EMA or MEA, that's a bit strange. And obviously I had a little bit of an episode when I wrote that, is more than 2% on initial risk, then switch to the 10 EMA. What do I mean by that? Well, sometimes it does this. Okay. Let's not look at gold. Let's look at gold. Let's look at something else. All right, the great example. Okay, sometimes it does this. Okay. Now, let's say our initial, let's say on this breakout trade here, we decide to put a stop at this place here. Okay. Oh, it's not the best entry in the world, but let's say we got into it anyway. Okay. So at this stage, the gap is 23 pips. Okay. At this stage, the gap between this and the 20 EMA is 60 pips, so more than 2 times our risk, in which case you'd switch to the 10 EMA and we'd get out there, okay? So we get out at 54 pips profit rather than 51 pips profit. So we've, generally speaking, this helps when there's been a move like this. Interestingly, if we put the SMA on, we'd probably be out, if we did our retracement method, we'd probably be out there. So at lower level, if we put our SMA on, yeah, email me about if you're interested in coaching. I can't talk about it on this session, but just drop me a line and I'll talk to you about it and whether it what we need to have a chat about. Okay, so EMA. Notice I've done a 10 and 20. Has changed the parameters on the MACD just to match the EMAs up above here. But if we're to use this again, signal line, and is now above the histogram there, so be out on this candle here. So that would be our best outcome with about 65 pips. Okay, so that's an example of testing one parameter versus another, but you need to have a system to do that. So what I'm going to do is I'm going to religiously trade. I'm going to have a critical mass of trades whereby I can just sort of say, well, look, now I've got 20 trades or 10 trades in this strategy. I can have a look at alternatives and see what difference it would have made. And look, have a test of yourself. If you've got a journal, and by God, I've banged on about it enough at this stage for you to actually consider it, I think. But if you have got a journal, and have a look at your exits. If you've got a standard that you would use, have a look at your exits. Try an alternative. That MACD signal is an easy one to do, and see what would have happened. See what would have happened. That's the way you do it. That's all you're doing. You're planting your flag. You test an alternative, and in this case, it's an alternative subsystem. So what we've covered today, and to finish it off, because I'm well over my time, is really what I've tried to do is give you some more meat around those bones. So we've had a look at the individual strategies, individual entry strategies. As I said, drop me a line if you want. There's a few things I've asked you to drop me a line about. If you want a copy of the handout of that 8 strategy considerations, or you want what else did I suggest? yeah, if you wanted to ask about coaching, or if you wanted to find out more about what else is available in terms of education, then do so. And of course, you are enrolled for that. But ultimately, it always comes down to one thing, and this is what we started off right from the get-go, right on the session we had last week. You have a choice to have a trading plan, not to have a trading plan, to make that trading plan sufficiently comprehensive and specific and unambiguous in its statements, or not to. You have a trading plan which you subsequently measure, or you choose not to measure. You ask yourself this question: what's the likely impact on results if you make choice 1 versus choice 2, or choice 2 versus choice 1? If you're serious about trading, I think the choices are clear. So all it remains for you to do is to pop off and go do the work, because we know that work at the front end creates the results at the back end. I have to drop your line about the list of lines you want us to drop to you. Joe, you're very welcome, mate. And you, Michael, too. Just making sure. Oh, yeah, if you want the record, as I said, if you want the recording from this session, then just use the link that you got for the last one. I'll put it in the same place. That should be up later this evening when I've had a cup of coffee and chill for a little bit. And yeah, look, just do me a little favor. Obviously, this is the second time I've run this intermediate clinic, and it's changed quite considerably since the last time. I'd just be really interested in how it was for you. So if you can wouldn't mind just investing a click of a button to let me know, that would be great. Awesome. I'm just quickly looking down the list just to make sure. A couple of you are going to drop me lines about coaching. A couple of you want, yeah, Peter, it's going to be available for sure. Yeah, absolutely. Same link, Peter. You're welcome, Stephen. Always good to see you here, buddy. Keep up the good work. You're welcome, Chris. Okay, guys. Well, look, watch out, Fitness Circle. I'm changing the topic tonight, and I've completely forgotten in all the excitement what the topic is. So I'll be changing the topic later, but just keep an eye out for that. I'm sure it's something extraordinarily exciting. Just thanks for the feedback on the poll. Let me just, if you give me a second, I'll just tell you what it is. Interesting, the future's looking very sweet. If you're looking at the NASDAQ. Give me a second and I'll be with you. I'm just, sorry, I should know this off the top of my head, but I've just, sometimes when you've done a couple of webinars, 3 webinars today I've done, things just get a little foggy in terms of which webinar you're doing next. So just bear with me. There we go, that's the document we want. Okay, so yes, we're gonna talk about matching timeframes to market conditions. So we're going to talk a little bit about. I'll just put the futures up so you can have a look at those. We're going to talk a little bit about. Yeah, a little bit about timeframes again. Just reiterate the key points, and then look to how we start to identify that maybe one time frame is out of bounds for right now, and another time frame might be the way to go. So that's tomorrow's session. A few rules of the game around that. Ross, you have a good night too, buddy. Cheers, Andrew. Thanks heaps. We'll see some of you in a circle tomorrow, and enjoy the rest of your evening. I'll check out with Nigel when he can do another session for us because it's well overdue. David, you're welcome, mate. Take care. I will. Thanks, Ewan. Might be Eric. Too easy, mate. Too easy. Okay, guys. Well, look. Take care. We'll see you again soon. Bye-bye for now.